Some people are aggressive, some people are conservative. The beginner's guide to stocks versus bonds is what we're going to talk about and how you can get started today. So Peter, what is the difference between ETFs and mutual funds? Speak to me, speak to the audience like they have no idea what those are.
Well, first and foremost, mutual funds are just a series of stocks that you invest in, right? And so, there's usually a portfolio manager that manages that series of funds, whether it's going to be in robotics, whether it's going to be in technology, whether it's going to be in geographical regions. That's usually mutual funds, right? It's just a group of stocks with a common goal.
Okay. And then what about ETFs?
Well, ETFs, basically, you're getting a series of industries. You might get sectors, you may get, a Standard & Poor's index.
So like an index fund?
Yeah,
so it's
a little
the same
bit
thing?
Like they pretty much mirror an index or a series of assets.
Is that the same as an index fund or not the same?
Well, certainly an index fund could be an ETF,
okay.
right? But also an index, you could invest into mutual funds as well. Ultimately, here's the bottom line. A lot of people invest into mutual funds. A lot of those people are now moving into ETFs. And the reason for that is because the lower management fees. As a matter of fact, all mutual funds, I don't believe in mutual funds. They're bull. To me, I don't think
so. Tell me about the management fees. So like if I've never invested in mutual funds, which I've never invested in mutual funds, what happens? I pay the bank some money and then what do they do with it?
Well, what the banks do is they actually deploy your money with the funds, right? So whether the funds are built by the banks or whether they're built by fund managers, what ultimately happens is you pay a fee for them to manage your assets. So if you deploy $100, whether the stock grows or the underlying assets grow or not, you're actually paying for them to do usually nothing at all.
Okay, so like I pay them $100 and they're going to invest it in a bunch of companies and then they take a management fee.
They take a management fee
like
for your assets.
$10?
No, it's usually 1.5%, 2%.
Okay, 2%.
So here's the thing though. Here's what kicks me in the butt. Whether they do anything or not, and whether they exceed the market, their job is to exceed the market, right?
Okay.
You don't go out there in real estate and actually look for people who goes, you know what? Yeah, what I invested into did worse than everybody else, but yet you still get paid. They're based upon performance. They should be based upon performance, but a lot of them don't exceed the performance of what their peers do, and that's why everybody is moving into ETFs. That's why there's so much money moving into ETFs.
So mutual funds you don't agree with. You don't like them.
I don't like them.
So ETFs,
that's for the average, right? The mutual funds are for average people.
Okay, what about ETFs? Is there a management fee on that?
Significantly less.
Okay.
Because it mirrors is automatic. So it mirrors the market. It mirrors the funds, the underlying assets. So therefore, the amount of performance is not really managed by a portfolio manager. So ETFs are a lot less expensive for the most part. And I do like ETFs.
So they sell ETFs at the bank or?
A lot of it is self-management. You can actually manage your own assets, whether it's an RSP, TFSAs. You can have an open investment. Okay. You can do all that even on your own through the click of a computer. You don't really need somebody to actually manage those assets. But yeah, I'm sure some of the banks would do ETFs and allow you to do that.
Okay, so then ETFs are much better than mutual funds. What about the returns? Returns.
Well, usually, here's the thing. Here's the kicker, right? So, here's the fundamental flaw of mutual fund, right? It's not really the portfolio manager. It's really about how the underlying is. You got to understand how these things work. Portfolio managers, they care about their job more than my money, right? Okay. Nobody cares more about my money than me.
Correct.
Right? That's how wealthy think. We don't think about, let's just go give somebody money and see what happens, right? We do not take our money by chance, right? We don't. If we do that, we just go gamble, right? Yeah. Just go to the casino and go for one or the other and see if you win. That's not how the wealthy get rich, right? That's not how we stay rich too. So you have to understand in terms of mutual funds, the fundamental structure. Now, here's the bottom line. With mutual funds, I'm sure a lot of your clients invest into mutual funds. They talk about it, right? They go to the bank and, yada, yada. Great. But mutual funds, the 1.5 or 2%, sometimes you have redemption fees. So your money is actually stuck in there unless you want to pay a fee to take your money back out.
You have to pay a fee to.
You have to pay a fee to take your money back out.
Okay.
Right?
Okay.
So here's the thing. With portfolio managers, when they build, so number one, they have a fee structure. So whether things grow or not,
they're taking that 2%.
They're taking that money.
Management
right?
fee.
So that's okay if they're beating the market, right?
Okay.
But very few mutual funds beat the market year in, year out. There are a few. There's definitely a few groups of people out there that can beat the market, but there's not that many. And most of them you're not exposed to.
And most people aren't that exception.
Most, definitely not, right?
Yeah.
1% of that amount of people are exceeding the market. But when I look at that, not only the exception, for the most part, they're charging you that management fee. And when they charge you that management fee, whether it grows or not, they're taking money. Okay, so that's number one. Number two is that when the market, even if they knew the market was going to take a big jump, nosedive, they're still invested in the market. So one of my mentors, Dr. Tan, talks, the Asian Warren Buffett on value investing. He talks significantly on never be invested fully at all times, right? That's what most funds do. They're sitting on 1, 2, 3% on cash. So even if they saw the market take a tank, what do they got to do? They still invested in those core assets.
So wait a minute. So you're saying like there's a fund of $1 million and they only have 1% of cash, like $10,000 in the.
Well, here's the thing. If you were an investor, you wouldn't want to pay them 2% on managing cash, would you?
No.
Right? So that's the chicken and egg thing. You pay them to manage the money, but at the same time, nobody knows when the market's going to take a big tumble, right? So their mandate is to have most of the money deployed all the time. So when it tanks, guess what? All your money goes with it.
Tanks with it.
Right? And their thing is all it is about beating the performance of the index. So if the index does 5%, their goal is to hit 5 and or more. And we talked about that because there's fees and everything else. Not too many exceed that. Yes, there's exceptions.
They could be like 5.6, but then minus the 2%.
But usually, let's say they exceed 5.6 on the market after all fees, right? Fantastic. They get the award. They go, get a pat on the back. Did a great job. But guess what happens after, right? What goes down when because they have so much money being deployed at any one time, when it takes a big tank, what do? All those funds went with it. All they want to do is actually go and perform over the index. That's all they're designed to do, right? Okay. So what ends up happening, even if the market tanked by 10% and they did -8, they're the hero, right? That's the fundamental flaw of mutual funds.
Okay.
Because of the fee. Secondly, is even if they saw a financial collapse, they can't do anything because their mandate is to have that money deployed for the most part.
Because they only have 1 or 2% in cash.
5%. I mean, what's 5%? So even if you had all that money and you saw a financial collapse coming, you see the challenges of it, you as a customer would never want to provide them with just managing cash and charging you 2%, right?
Okay.
So that's the second thing. Because of the build of the mutual fund, that's where a lot of people are moving away. People are moving to ETFs. People are moving to alternative investments for that one reason.
Okay.
Right? And so that's why I don't believe in mutual funds. It doesn't mean that you can't. I look at robotic investing a lot more where it's fully managed, right? Yeah. But at the same time rebalance automatically where my fees are really low. Because at the end of the day, fees will dig into your returns year after year after year. Yeah. It doesn't make a big difference from day one, but as the performance of the fund delivers over a long period of time, as investors, we look for long term, right? So therefore, as the time goes around, the compound interest of the fee really adds up.
For mutual funds, right?
Absolutely.
Okay.
Right? I'm not saying ETFs don't have that, but dramatically less.
So we'll talk. So we have the flaw number 1 is that they have the management fee. Flaw number 2 is that they have low cash reserves.
Low cash reserves at all times. They have to be invested.
And was there any other ones?
Well,
the redemption fee.
Redemption fee. I don't like
if
fees.
You want to take
right?
any money out? Okay.
Yeah, I don't like fees.
ETFs have fees too, but just much lower.
Much lower. Much lower.
Okay. And then, so what do you say? Because this video is about beginner's guide to mutual funds and ETFs. What do you say to that beginner out there who has no clue, never bought an ETF, never bought a mutual fund out there? Obviously, do your due diligence. But then, what other warnings or tips that you could give them?
Well, a lot of people ask me about where should I invest. Well, it's not necessarily where because we can only know so much. But number one, be invested, right? Be in the market because that's the only time that it makes a difference. Number two, know your stuff, right? Start doing your research. But if you don't, I would say look into robotic investing, right? Look into ETFs.
We'll talk more about robotic investing in another video.
Yeah, absolutely. I mean, that's what I see because that's how I build my fundamental emergency fund.
Okay.
I have robotic investing manage all that because that allows me to be flexible, earning income at the same time while having that ability to redeem anytime.
Okay.
Right, with very low fees. If I was to choose between the two, I'd go ETF. But I'm not saying mutual funds aren't good, but you got to know the portfolio managers. You got to know their mandate. You got to start doing some research. Don't listen to your brother-in-law that's a plumber because that's not going to work, right? You know what happens last year doesn't mean it's going to happen next year.
The track history, because
right?
most people fall into that.
Yes,
like,
then you need to know who the portfolio manager is.
They're like,
because
oh,
it's the
so and
people.
so fund, right? Oh, it went 30% year over year, but.
Absolutely, it's their investment philosophy. So you have to buy into what the fund manager is investing in, right? So you look at the track record of what a realtor does. Hey, when you were able to work on my investment portfolio, how are you able to get under market? Are you able to tell me what's going to be the next area that's going to be of growth, the area that's not going to be today, tomorrow, but a year, 5 years, 10 years down the road?
Exactly.
That's the key, right? It's looking forward. So for the very new investors, I would say this: make sure you start investing, because if you're not, your money's not growing and your time isn't compounding, right? You want to make sure your money is working for you. So you want to be involved in at least looking at ETFs. You want to be looking at robotic investing. You want to make sure your fees are minimized, and you want to make sure that you go out there and meet the people that can help you in your investing, whether it's in real estate, stocks, bonds, or any other portfolio. Make sure you do your due diligence.
And if you have a lot of inner dialogue and that's holding you back from investing, check out our other video over here, and we talk a lot about the things that hold people back from investing. So for more information about investing, stay tuned, because we're shooting more and more about wealth and money. Thank you for watching my video. Tell me what you liked about it. Comment below. And if you haven't done so already, subscribe and turn on the notification bell so you'll be notified of future videos. And if you want to learn more about real estate, click the videos over here.